So based on the material, what's the biggest factor? The thing cited most for companies, for investors, holding off on big deals. What's the main issue?
The core issue, according to the analysis we've seen, it really remains the need for clearer macroeconomic visibility.
Macro visibility.
Yeah, deal making, it inherently involves making forecasts, right, about future performance of the combined company. And right now, there's still, well, maybe too much uncertainty, too much volatility in the broader economy to make those forecasts with real confidence.
And the sources specifically mention things like potential tariff flip-flops. That sounds disruptive.
It does, and also just the sheer rate of news flow coming from the new U.S. administration, that's contributing to the uncertainty too.
So it sounds like companies are finding it hard to build reliable financial models when basic economic policies feel like they could shift sort of unpredictably.
Yeah, that's the central point here. The thinking is that deal makers, they just need a stable base, a platform to project revenue, costs, market conditions years out.
Right.
And when policies, particularly things like international trade or regulation, are in flux or, subject to sudden changes, those long-term projections become way less reliable. It just introduces this layer of risk that makes those huge commitments harder to justify.
It's almost like trying to plan a long road trip when the weather forecast keeps changing drastically every hour.
That's a good way to put it, yeah. You have a destination, but you're hesitant because you don't trust the map or the forecast.
Right.
And the material makes a really critical distinction here, I think. It's not necessarily that you need a bullish market, like a booming market, for deals to happen. What's needed is a consistent market, even in an environment that includes, say, tariffs or anticipates lower growth, that can still support M&A activity if that environment is stable, if it's predictable.